Just sold or planning to sell a commercial property? Then you are about to meet one of the biggest tax bills in real estate, capital gains tax. But here's the good news. There are legal strategies to reduce or even eliminate it entirely. In this video, we are breaking down the following concepts. 1. How are capital gains on commercial real estate calculated? 2. What is the difference between short-term versus long-term gains? 3. What is depreciation recapture? It is also called the IRS's hidden clawback. And finally, we will talk about some of the smart strategies like 1031 exchanges, opportunity zones, and installment sales. Stick with me till the end, and I'll show you how one of our clients sold a $2.4 million property and legally deferred every penny in capital gains. What is capital gains tax on a commercial property? When you sell commercial real estate for more than you paid, the IRS sees that profit as a capital gain. You pay tax on the difference between your adjusted basis and the sale price. So what's your adjusted basis? It's your original purchase price. Here is the formula for it. It's capital improvements, depreciation you've claimed over the years. Let's say you bought an office building for $1.2 million, made $100,000 in improvements, and claimed $200,000 in depreciation. Your adjusted basis equals $1.1 million. You sell it for $1.8 million, and therefore, the capital gain is $700,000. So on paper, that $700,000 looks like pure profit. But don't get too comfortable just yet, because before you even touch that money, the IRS takes a bite. Moving on to the next concept, what is the difference between short-term and long-term capital gains? Not all capital gains are created equal, and the IRS knows it. If you sell too soon, and you could lose nearly 40% of your profit to taxes. Hold longer and you unlock major savings. But even then, there's a hidden tax trap waiting. Capital gains are taxed differently depending on how long you held the property. If you hold the property for less than a year, it's called a short-term capital gain, and they are taxed as ordinary income, up to 37% federally. However, if you hold the property for more than a year, it's called long-term capital gains, and they are taxed up to 20%, depending on your income level. What is depreciation recapture, also known as the hidden tax? When you depreciate your property over time, you reduce your taxable income each year. But when you sell, the IRS takes a cut of that benefit back. This is called depreciation recapture, and it's taxed at up to 25%. So if you claimed $200,000 in depreciation over the years, you could owe $50,000 in recapture tax even before your capital gains are taxed. Here are some of the facts that you need to know. Depreciation is not free money. It's a temporary tax deferral, not a permanent write-off. Recapture applies even if the property lost value. It's based on depreciation claimed, not your actual profit. You can't skip it. The IRS tracks depreciation whether you used it or not. You still owe recapture tax even in a 1031 exchange, unless you defer 100% of the gain and depreciation. Here is a pro tip. Always run a pre-sale tax projection. Selling a commercial property without accounting for recapture can cost you tens of thousands. Here are 3 legal strategies to defer or eliminate capital gains. 1. Doing a 1031 exchange. Sell your property and reinvest in a like-kind property. You defer both capital gains and depreciation recapture indefinitely, but the rules are strict. 1. You must identify the new property within 45 days. And 2. You must close within 180 days. The IRS is very strict with the timelines. Used correctly, you can roll profits from property to property and never recognize a taxable gain. 2. The next best way to defer capital gains is by investing in opportunity zones within 180 days of the sale of property. The benefits are: 1. You defer tax on the original gain, and 2. Pay $0 tax on future growth in OZ if held for more than 10 years. It's a great strategy for investors looking for long-term tax-free growth. And lastly, doing a structured installment sale. In this case, you sell the property and get paid in installments over several years. You spread the gain and the tax over time, improving cash flow and keeping you in a lower bracket. Used wisely, it's like income averaging for real estate. Here's a real example. With a $2.4 million sale, the client paid $0 in capital gains taxes. Let's make this real. How smart planning turned a massive tax bill into zero taxes owed and built long-term wealth in the process. Here's how one of our clients did it right. He owned a commercial warehouse for 11 years. Original cost, $900,000. Sale price, $2.4 million. Depreciation claimed, $300,000. Adjusted basis, $600,000. Taxable gain, $1.8 million. That should have meant $360,000 or more in taxes. But we executed a 1031 exchange into 2 multifamily properties. The result? $0 capital gains recognized, no depreciation recapture tax, bigger cash flow from replacement properties, estate planning benefits for his kids. He kept the full equity working for him, legally. This is the power of strategy over reaction. He didn't just sell, he repositioned his wealth, multiplied his income, and paid nothing in capital gains. And you can too, with the right guidance before the sale. Here are some of the common mistakes to avoid when selling commercial property. Even seasoned investors get blindsided by capital gains taxes, not because of the rules, but because of poor timing, paperwork errors, or choosing the wrong structure. Mistake 1. Selling before the 1-year mark. If you sell a property you've owned for less than 12 months, your gain is treated as short-term and taxed at your ordinary income rate, which can go as high as 37%. This can nearly double your tax bill compared to long-term capital gains rates of up to 20%. Mistake 2. Ignoring depreciation recapture. Too many investors focus only on capital gains and forget about the recapture tax. If you've claimed depreciation over the years, the IRS will claim up to 25% of it, regardless of profit. Mistake 3. Missing 1031 exchange deadlines. A 1031 exchange can defer both capital gains and recapture taxes, but the IRS gives you zero flexibility on timing. You must identify replacement property within 45 days and close within 180 days. Capital gains tax on commercial real estate isn't just a cost, it's a planning opportunity. At Gavtax Advisory Services, we specialize in tax planning for real estate investors. Before you sell, let's run the numbers. Book your free 15-minute strategy call at gavtax.com. Don't leave money on the table. See you in the next video.